As Basel III and other capital rules come into force, efficient use of capital has become a global priority. Neal Brady, CEO of Eris Exchange, sees that as the key to the continually increasing popularity of swap futures.
Eris Exchange was founded by a group of firms that looked out at the landscape and the coming regulation in the wake of the financial crisis. Basically looked at the coming regulation and the constraints on OTC behavior and realized that there was a space and a need for a product that was a futurized swap that met all of the requirements that the regulators were put in the market, but allowed people to trade in a more capital efficient manner and allowed more access to the market. The Eris methodology, in essence, takes all of the periodic cash flows of a traditional OTC swap and packages those and compresses them all into a single futurized contract design. So that the only money that moves at the end of the day, like in all futures contracts, is the variation margin, and yet the economics of the contract, fully replicate an OTC swap and all of its cash flows. Capital efficiency has always been important in OTC trading and in futures trading, but what's particularly hitting the market these days are the leverage ratios, which you may have heard about. These come out of the Basel III framework. And it's effectively, a lot of complicated math and footnotes and regulation around this, but it basically comes down to that gross notional exposures are treated poorly. We require banks to hold a lot more capital on their balance sheet. There's not really a risk-based methodology to a lot of the frameworks that the leverage ratios are applying. So in essence, what this forces banks to do is trade in a more standardized fashion, and clients as well, because as banks are hit with charges holding gross notional outstanding, they need to pass those costs on to clients. Essentially, any of the countries that were affected by the Pittsburgh Accord back post-crisis, broadly speaking, the G20 countries, they're all feeling the impact of this. They have to accommodate, their banks have to adhere to Basel III standards. They have to meet the requirements that were set up by in the G20 Accords. And you're seeing the impact across the globe, just in different timing stages. Broadly speaking, there are really three ways to treat an OTC swap that needs to be cleared. Number one, it's trade it the same way you always have traded it, but put it up to a CCP for clearing. The second way to do it is you could potentially deliver into a swap. So you trade it as a future for a certain period of time, and then at expiry, you deliver into a swap. There are variants on that product that are out there. And then the Eris methodology is the third bucket, which we believe is becoming validated as the leading solution. And the difference with Eris is it's fully cash settled. It never delivers into a swap. It stays as a future for the life of the product. And then you can hold the product to maturity. So you put on a 5-year swap, even if it's a standardized IMM dated swap. You put it on for 5 years and you hold it all the way down the curve, hold it to maturity. So we see, really about 50-50 between traditional users and new users have been shut out of the swap market. On the traditional user side, we have a whole host of end users coming to us because they've recently been visited by their prime broker or their clearing firm and told that their clearing costs are going up by a factor of 3 to 4x. That's all driven by the Basel capital charges and leverage ratios we talked about earlier. They're trying to find a way to continue to do the business they do, but do it in a cost-effective manner. In some cases, they've even been fired by their clearing firm, told that they don't do enough business to justify clearing relationships. On the other hand, the other 50% of the users that we're seeing come on are guys who've been shut out of the market traditionally. They don't have an ISDA with one of the largest 5 banks that trade swaps. These are guys who, traditionally in futures have done high volume spreading against other products, cash instruments, Eurodollar strips, treasury futures. These are guys who now, for the first time, have access to an order book and can put on a spreading algorithm, can enter the market. Another product where we're seeing quite a bit of marketplace interest is in options, specifically a standardized swaption contract on one of our standardized swap futures. Options are particularly hard hit in the new capital regime. They're traded, currently OTC with lots of different flavors, with lots of customization, which creates lots of gross notional outstanding. So there's a real need in the marketplace, we believe, for a standardized product that would be treated better under Basel and would allow more people to enter into the swap.